Last time we dealt with portfolio theory and the Markowitz portfolio model. This module leads us from the portfolio theory to the capital asset pricing module. Portfolio theory and the Markowitz portfolio model are something that financial advisors use almost on a daily basis if you look at what they actually advise. And the portfolio model, or solving for portfolios given assets, are something that's done often, and you'll see a lot of portfolio models in practice out in the profession. There's also a couple insights, three insights that I'm going to point out that are very important with the portfolio theory. The first is that diversification increases risk efficiency. We can increase risk efficiency by holding more assets as long as those correlations of asset returns are less than 1. If we hold 2 assets, we will be less risk efficient in general than if we hold 3, 4, 5. And again, risk efficiency here is for a given level of risk, we can get a higher return given that we're holding more assets, or stated alternatively, for a given level of return, we can lower risk by holding more assets. The second insight is that investors will hold one market portfolio and then adjust for risk preferences in the financial markets. We don't see many, or we don't see all investors holding one market portfolio, but in fact we do see quite a bit of this insight in practice when we see people holding index funds. Again, but the idea here is that rather than looking at each individual asset and assessing its risk preferences or riskiness of that asset, we can look at the market portfolio. The third is the distinction in roles of capital and financial markets, and in particular, one of the roles of the financial markets is trading risk between investors. There are problems with the portfolio model. One of these is that they rely on means and variances to characterize distributions, and again, this is covered in the textbook as well. Typically, what you see done is for an asset or a portfolio, means and variances are estimated from historical data, and then it's assumed that those means and variances will persist in the future, and that means characterize the expected return and variances characterize the expected risk. We do know, however, that when we look at our distributions, we have evidence of fat tails and non-systematic distributions. And fat tails in particular mean that there is a higher probability of adverse events than is given by our standard normal distribution. For example, let's take a return that is 4 or 5, 6, maybe even 10 standard deviations away from the mean. The probability of that happening is higher than we would project using the normal distribution, or for that matter, many standard symmetric distributions. Same thing on the top high end. What we typically observe is more very good or plus to the plus side realizations of returns than are implied by our normal or symmetric distributions. Again, we do see that, and we do observe that in practice. The question, though, is once you've observed that, what are you going to do about it? And there really aren't any good ways of handling it at this point. Handling it would require full-blown simulation models, and probably what's more critical than the method for looking at how returns would evolve over time is coming up with an estimate of really what are the chances of those adverse events and good events. In my opinion, the existence of fat tails and non-symmetric distributions, but in particular fat tails, points to the importance of diversification. We know, based on history, that adverse events are going to happen, and they will happen again. To counter that somewhat, diversification, holding more assets in variety of industries in a variety of ways where hopefully we get correlations away or low correlations amongst those assets will protect us somewhat from the what happens when we have fat tails. This problem with the portfolio model led to an interesting exchange between Black Swan author Tali and Markowitz himself, the maker or the developer of the portfolio theory. You can actually see this exchange in a blog called Mostly Economics. I've listed the web or the link above there, just above the title. I've also put it on the website so that you don't have to type it in. But Taleb said, I would tell people to learn more accounting, more computer science, more business history, and more financial history. And he's now talking about what students should be taking in classes related to financial theory. And I would ban, and it goes on, and I would ban portfolio theory immediately. And it was his premise that portfolio theory and more generally mathematical models led to much of the problem that led up to the 2008 financial meltdown. Markowitz replied to this, and you can see part of his reply here. And again, go back to the website if you want to read it all, or the blog site, and they have links to a more fuller description of it. Markowitz basically said two things. One is he distinguished portfolio theory from financial engineering. And financial engineering is more generally thought of as putting assets together, synthetic assets or developing assets from underlying assets, and that was part of the process that led to asset-backed securities. And Markowitz also noted that his portfolio model typically leads to something like a 60-40 split between stocks and bonds. And again, many people would have that stocks in a portfolio that mimics a broad market index, similarly with bonds, and that if you had something along that lines, you were hurt less than others who held less diversified portfolios. And to a certain extent, that is certainly true. And again, going back, remember the stocks returns and bond returns that we showed as part of our practice homeworks. We had a very high, our large return or large negative return for stocks in 2008. But if you had bonds in your portfolio, those returns were positive and partially countered the downward decline. Point of this again, though, is that the portfolio model does have its weaknesses, particularly when it comes to dealing with assets with fat tails. And one of the things that you may want to consider as you're looking at assets, determine or look at or think about whether or not there's a higher instance of fat tails with this asset than with other assets. The second problem, or a second set of problems with the portfolio model, is determining mean, standard deviations, and correlations. And this actually is a problem with all models, but the one that to focus on here with the portfolio models are the correlation coefficients. And as the number of correlation coefficients increase, the number of asset correlation coefficients that need to be estimated and put in the portfolio model increase dramatically. And here you can just see it. I'll give an example here in the red. If you have two assets, there's one correlation. If you have three assets, there's three correlations. If you have four assets, there's six correlations. 5 assets, 10 correlations. And then for n assets, you can see the formula there for calculating the number of correlation coefficients you will need. As you approach any reasonable number of assets that you would include in a portfolio, or think about estimating correlation coefficients for all assets, in the Dow Jones Industrial average, 30 assets, you quickly run out of data to estimate all those correlations, because there's more correlations or more correlations that need to be estimated than there are degrees of freedom or data that exist. What that in turn causes is those correlation coefficients are very hard to come up with accurate estimates of what they are. A third problem with portfolio theory, and this is actually a more realization of the shortcoming of portfolio theory, or not incorporating all the information you have when you conduct portfolio analysis, is the realization that portfolio theory does not consider what market characteristics would say about asset returns. You have a market in which people are bidding for an asset or building into the price of the asset their expectations of the returns for that asset, and that implies certain things about the relationship of returns between assets. And one of the things that comes out of that is that risk for an asset should be defined by what it contributes to the risk of a well-diversified portfolio. The realization that the portfolio model, when it derived its efficient frontier, did not include characteristics of the market when developing that efficient frontier, led to the development of the capital asset pricing model. And that's what we'll discuss in our next module, the Capm, or capital asset pricing model. And the capital asset pricing model simply builds into it that in equilibrium, investors will price assets in keeping with their returns and risk. And if that weren't the case, individuals could go out and buy underpriced assets and generate excessive returns and vice versa. And again, in equilibrium, we wouldn't expect that to happen. And again, CAPM will be discussed in our next module.